Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report from AGENUS, a company that calls itself an immuno-oncology business. Now, I know that's a mouthful, but don't worry, we will decode it together. And trust me, with all the financial juggling they are doing, it is like watching a magician trying to pull a rabbit out of a hat, but instead of a rabbit, it's funding. Let's jump straight into it. AGENUS just filed what's called an 8K report. Think of it as a company's way of saying, hey, big news, to the Securities and Exchange Commission, or SEC, and to everyone else keeping an eye on them. This particular filing is all about a deal they struck with some of their lenders, the people who loan them money. The main headline, AGENUS needed to push back the date when they had to repay some debt. That debt is in the form of notes, like IOUs, worth $10.5 million. These notes were originally due in February of 2025, but now those lenders have agreed to give AGENUS a little more breathing room, 16 months more to be exact, pushing the deadline to July of 2026. In simple terms, they kick the can down the road. But extending deadlines comes at a cost. The interest rate, which is like the fee AGENUS pays for borrowing the money, went up from 8% to 9% per year. It's like saying, thanks for giving us more time, we'll pay you a bit extra for the trouble. To make the lenders feel even better about this deal, AGENUS is putting up some property as security, specifically AGENUS West LLC, which they own. This means if AGENUS can't pay back the loan, the lenders could potentially take ownership of that property. It is like putting your house up as collateral for a loan. Now here comes another twist. Those lenders also had warrants, which are like coupons to buy AGENUS stock at a set price. AGENUS extended the expiration date of these warrants to 2030 and changed the price you would pay to exercise them, which is $3.25 per share. Basically, they are sweetening the deal to keep the lenders happy. It's as if AGENUS said, we know we are late on our payments, but here, have a chance to buy our stock at a potentially good price in the future. And to top it off, AGENUS is giving these lenders even more new warrants to buy even more shares of their stock. Specifically, these warrants would allow the lenders to buy 67,500 shares, also expiring in 2030, with that same $3.25 price per share. AGENUS is promising to register these new warrants with the SEC within about 3 months. This is a necessary legal step so the lenders can actually trade these warrants. There's also a price protection clause, which is really interesting. If AGENUS raises more than $10 million in funding before February 2026, and the price per share is lower than $3.25, then the warrant price drops to match that lower price. This protects the lenders, ensuring their warrants are still valuable even if AGENUS has to sell stock at a discount. AGENUS still needs to figure out how to pay off another $2.5 million of those 2015 notes. They are hoping to do this soon with yet another financing deal. It sounds like they're constantly looking for new money to pay off old debts. The full details of this agreement, called the amendment, will be in their annual report. The actual paperwork for these warrants are attached as exhibits. If you want to dig even deeper, you can find more background on those original 2015 notes in a previous report. The company filed that report with the Securities and Exchange Commission back in February of 2015. These new warrants weren't offered to the general public. They are using an exemption in the law that says they don't have to register these specific transactions. This keeps the process quicker and simpler. All the information about this deal is relevant to understanding AGENUS's financial obligations. And it relates to the sale of unregistered stock, meaning stock sold without going through all the usual SEC hoops. If you are curious about the exact forms of the warrants, you can find them attached as exhibits to this report. Now, let's zoom out and consider what this all means. AGENUS is essentially buying time. They are pushing deadlines and sweetening deals to keep their lenders on board. This suggests they might be facing some short-term cash flow challenges. Think of it like using a credit card to pay off another credit card. The fact that they are securing the debt with property indicates the lenders are getting a bit nervous, and AGENUS is willing to offer more security to reassure them. It is like promising something valuable if you cannot pay. The warrants are a way to share potential future gains with lenders, but it also means that existing shareholders could see their ownership diluted if those warrants get exercised. One big risk is if AGENUS can't secure that new financing to cover the remaining $2.5 million of the notes. That could put them in a tight spot. However, if their research and development pay off and they get a successful drug to market, this financial maneuvering might just buy them the time they need to succeed. In conclusion, AGENUS is walking a financial tightrope. They are betting on their future success to overcome current financial pressures. While the company is still moving, it's essential for investors to keep a close eye on their cash flow, debt levels, and progress in the clinic. The long-term sustainability of this company rides on those factors. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more corporate decoding.